Good afternoon, everyone. Thank you so much for joining this webinar. And I want to start by apologising. We're really sorry about the IT issues we had a couple of weeks ago with this webinar. And thank you so much for joining us again. The webinar today is being hosted by the Northwest Net Zero Hub, Landscape to Ledger, Stimulating Local Natural Capital Markets. Just as a bit of background, this is our third webinar in this series of natural capital topics. The Hub itself isn't directly working on natural capital projects, but we are certainly following what the local authorities are doing. Today, just to run you through the programme, Alex, if you could just move the slide, we've got, I'm going to give a bit of an overview, and then we have Emily Diamand from Nature North, and she will give much more of a detailed overview, scene setting, the state of play. And then we're very lucky to have an investor here, so that's Reaney. She is Head of Commercial Strategy for Rebalance Earth. She'll talk about what makes an investable project. We've got Luke Baldwin. He's the CEO of Nature Broking. He'll talk about building buyer demand. And then we have Ed Asseily. He's the CEO of Zulu Ecosystems, and he will talk about designing scalable investor-ready programs across landscapes. And then we have Krista Patrick. He's the Natural Capital Coordinator for the GMCA, and he will be talking about supporting the emerging BNG market. We will then have an open session with the panelists, and we will be talking about how can you make nature is priceless. Why are we putting a value on nature? We will then open the floor and do some Q&A as normal. So if you have any questions, please go into the Q&A tab. And if there are some questions that have more ticks than others, we will go straight to those and ask them. I think it's important as a bit of context to talk about the UK natural capital market. Now, according to DEFRA, the BNG market itself, the estimated size is around 135 million to 275 million a year. This was from a DEFRA report in 2023. And there's over 6,000 hectares of habitat that may be required annually for BNG obligations. There's obviously the peatland, woodland and carbon code markets, and their forecast is around 1 to 2 billion per year. There's the nutrient and water quality markets too. From a local authority perspective, because that really is our audience, essentially, particularly here in the North and the Northwest, the local authorities have different roles to play. They are landowners, they are land managers, but obviously they are involved in the planning process. There is that opportunity for them to perhaps be the sort of trusted intermediary or broker. So I will move over to Emily, and I have comments which I will just add as we go along. Emily?
Thank you very much. Yes, it's really nice to be in this webinar today, and it's a really interesting lineup of people. I'm actually really looking forward to hearing everyone else's presentations. Because the other speakers can go into a lot more detail about some of the specifics, I'm just going to try and set the scene a little and also explain what Nature North is for those of you who don't know who we are and what we're doing. So if we could just go into the next slide, please. So Nature North is a northern scale collaboration to drive nature recovery at scale and to increase investment into nature recovery. So you can see in the partnership board, those are the original founding partners of Nature North, which was sort of an idea in 2020 and really got going in about 2022. And it includes the Natural England and the Environment Agency, Protected Landscapes, and the major conservation NGOs and the major funders of the environment. But in fact, the collaboration is now much broader than that. It's really genuinely cross-sector. We have businesses, partnerships. You can see in the Green Northern Connections investable proposition, which I'll be explaining about. That includes the major infrastructure providers in the north of England. And there's more than 50 now businesses, organisations, partnerships involved in Nature North. And in fact, many of those partnerships have many more partners than that. So the number is probably in the hundreds. So the aim of Nature North really is to collaborate at scale and to drive new approaches to investment at scale for nature. So if we could go to the next slide, please. So one of the ways that we're going about this is to create large-scale investable propositions for northern nature recovery. There were two propositions that were already in existence and became part of Nature North when it established, and those are the Northern Forest and the Great North Bog, which you may have already heard of. So the Northern Forest ambition is 50 million trees, and they have already planted 10 million since 2018 across the north of England. It's kind of the middle of the north. And the Great North Bog is all the peatland partnerships in the north of England, and their ambition is 7,000 square miles of upland peatland restoration. So it's essentially all the upland peat in the north of England. By scaling up and creating these kind of aggregate offers, it provides the opportunity to make a much more interesting proposition. And between them, they have now already secured £220 million for of public and private funding into northern nature recovery since 2018. So you can see that this new kind of approach is actually very successful. And what we're doing is replicating that across different habitats by bringing together stakeholders, partners, and interested parties around the different kinds of habitat. This is because each one has its own potential possible markets and also its own kind of specific circumstances about how you might deliver that nature recovery. And so we found that is to be the best way of working, and we're working with across these collaborations to do that. So for example, Rivers Nature North has recently published a prospectus of 15 catchment scale programs across the north of England that are seeking private finance, and we're taking it out as a kind of exploratory conversation with potential investors. And Green Northern Connections is bringing together the infrastructure providers, so road, rail, energy, canals, habitats, green infrastructure. And what we're doing there is we're supporting them to combine their efforts so that the work that they're already doing, that they have to do through, for example, the biodiversity duty, they're combining it together, and it's adding value and providing more value in that way. So this is the way that we're working, essentially aggregating up projects. So if we go to the next slide, please. We also work on policy, and we recently produced a strategic plan for a nature positive regional economy, which was launched in Sheffield by the Mayor of South Yorkshire, and then was launched again at the Convention of the North to all the mayors by Marion Spain, the CEO of Natural England. Before I go into the findings of that, we did a really large-scale engagement process in the autumn in order to develop that thinking with hundreds of people from different organisations and across sectors from across the north. But before I go into that, I'd just like to set the scene, do a little bit more scene setting to help with the kind of thinking about how we got to where we've got to, and also to kind of set the scene for the following speakers. So if we could just go to the next slide. So nature finance is a really busy space. There's a lot going on, and it may feel like, well, it feels to me like, you know, almost every day something new is happening and something new is emerging. And so it's just to kind of be aware of how much is going on. There are national initiatives. So, for example, the local investment in natural capital programs, which has provided funding to local authorities, and two of those are in the north of England, to explore mechanisms for acting, to explore mechanisms basically to bring inward investment, private finance into nature in those areas. And they've come up with some really interesting ways of working and approaches. Another one in the long list of possible initiatives that there have been, or initiatives that are happening, is mainstreaming nature-based solutions, and that's being driven by the water industry, working with Ofwat and the water regulators to both unlock barriers to using nature-based solutions and also ramp up in their investment into nature. They're already probably the largest private investors into nature recovery, and they're looking to how they can expand that from the current 3 billion to more than that in the next funding cycle. So there's a lot happening in terms of initiatives. There is a lot happening in terms of policy drivers. So, for example, the task force on nature-related financial disclosures, which is requiring is enabling and requiring companies to examine what their risks are with relation to nature and their dependencies, and then act to mitigate that. And that is then driving action by those corporations to driving demand for nature recovery. So that's one international driver. But within the UK, the UK government is also putting in place frameworks to provide more credibility to the markets. That's both the nature markets framework. The British Standards Institute is producing standards for credits. And there are also drivers such as biodiversity net gain, which is creating the regulated markets you're aware of, and things like the biodiversity duty, which is leading the institutions, so local government, national government, and statutory undertakers, which might be infrastructure providers. They are now required to consider biodiversity, and that is also driving demand because they're starting to think about what they need to do and what spending they might have to take on. At the same time, there are also policy drivers that are changing the way we can think about how nature recovery and nature finance might be delivered, particularly at the local and region combined authority level. So there's a devolution is handing a lot more powers. There's a lot more possibility to integrate nature into policy, into other funding streams, to create more blended finance options for nature recovery and nature-based solutions, to integrate it into the spatial planning, economic planning. And there are also further reviews about to happen. So there's call for evidence from the government around, there's two separate calls for evidence actually about funding for private finance into nature, and how they can drive that, and options and possibilities. So this is only going to increase, and the kind of push from government towards private investment into nature recovery is only going to increase, in our opinion. If we could go to the next slide. So very quickly, just to say, there are lots of different approaches, and you'll hear from some of them. It isn't just carbon markets, it isn't just biodiversity net gain. There are things like payment for ecosystem services, water, projects around water, for example, Resilient Glendronach, which is working with local businesses to fund improvements to the Glendronach River. There are things like the North East Carbon Marketplace, the York and North Yorkshire Buyers Club, the Greater Manchester Environment Fund. There are many different options. If you're thinking about how to fund something, or thinking about how you might be able to fund nature recovery in your region, look at around all the different approaches that are being taken, and this can, it doesn't mean that one size fits all. It might be that one approach really doesn't work for your habitat, or it doesn't work for your region, or it doesn't work for the markets, you know, the businesses locally that you're talking to. Well, have a look. There are many different approaches out there. I just really wanted to flag how many different ways in there are at the moment. So there's a lot to learn and a lot to kind of find out about. If we could go on to the next slide. So coming back to the strategic plan that we produced, there are a lot of pilots, there are a lot of these new innovations happening. But one of the things that we heard time and again was that we're stuck in a pilot phase, that it can be very hard to scale up and replicate. So this is where we have come up with a series of steps that we, as I said, we created with hundreds of different representatives talking about it from their point of view. And Those steps are quite high level on this slide, but under each of them sits a series of actions that multiple stakeholders can take part in, and also how Nature North will be supporting those actions and working to bring more collaborations together and help the North to really get in a good place to drive investment into nature into the north of England. So, for example, one of those is to create a single pipeline for the north of England to really create a really super aggregate offer that we can then send out to different types of markets, different investors. The aim is not to step on the toes of anyone who's working at the local level. We wouldn't be wanting to do this to interfere with what's already happening. This is to kind of provide support for the whole of the North. So that's why we include things like strengthening skills and capacity. And finally, I just again, in that process, we spoke to people about the need to have a set of principles. So investing in nature is like investing in anything else. Sorry, could we go to the next slide? Investing in nature is like investing in anything else, really. We need to think about how we're doing it, who we're talking to, how transparent it is, who makes those decisions, and it not becoming something that's imposed upon communities. And so this is why we've set up, we will be setting up a process to develop principles for the North of England, and these are a starting point. So again, ensuring that as we move into this new world where there is far more investment coming in, that is also protecting people and places and livelihoods across the North of England. And so I will now pass on to the next speaker.
I'm just going to pause there a second. So Emily, that was fantastic. Thank you for such a good overview. What really made my ears go up was this idea of creating a single pipeline for the North. And actually, maybe that is something we can discuss in the second section. It's a brilliant idea. Jenny from Preston City Council, I hope that, I think Emily did answer your point about BNG requirements. That all developments are subject to BNG. They must achieve a minimum 10% increase in biodiversity compared to the baseline. But if you've got any other questions, Jenny, on that, can you just put them in the Q&A? Thank you. Okay, so now on to our next speaker, and just want to thank Anne, because she only in the last week joined us as a speaker. So thank you so much. Over to you, Anne. Do you want to introduce yourself?
Yes, of course. Thank you so much. And thank you, Emily. I couldn't be more aligned on the principles that you just shared, and completely agree on the focus on how we can break out from pilots to work on how we can scale investment into nature, which is hopefully what I can unpack in a bit more detail today. So great to see everybody. My name is Anne Reaney. I'm head of commercial strategy at Rebalance Earth. Alex, if you're happy to flip on a couple of slides, I'll quickly do a bit of an introduction on who we are. So Rebalance Earth is a boutique natural capital fund manager, and we focus on really bridging the gap between companies, investors, and communities by investing in nature-based solutions with the aim of addressing some of our most critical economic and also social resilience challenges in the UK. So over the next 10 minutes, I'm going to do my best to do a whistle-stop tour on why we see nature as an economic imperative, how we focus really on the business value and the business value creation side of the picture to enable nature to become an investable asset class at scale, and what therefore that really means in terms of how we might think about that in investable project terms. So without further ado, let's dive right into that. First of all, I think it's really important to set the stage with a critical note on framing and how we view the problem of nature loss in the UK in order to get the traction we feel is required. As many of you will no doubt be fully aware, the UK is, of course, among one of the most nature depleted countries, not just in Europe, but in the world. And beyond the challenge that presents for our national pride, we also recognise that nature loss really threatens our economic stability in a multitude of ways, not least due to the vicious cycle in which nature loss can exacerbate climate change, and of course our changing climate also heightens our nature related risks. So at Rebalance Earth, we often say that climate risk manifests as water risk in the UK, either in the form of too much, so for example, flood risk, too little, for example, in relation to drought, which we're starting to see, of course, already, and also too dirty, so degrading water quality and water pollution. And all of these carry significant risks to businesses in the form of things like direct physical impacts, supply chain disruptions, asset value deterioration, fines and trade brand value, or even, of course, threats, frankly, to companies licensed to operate or their overall business continuity. If you can flip on a slide, please, Alex. And so within that context, important to note the research by the Environment Agency, which highlights the extent of the issue, specifically in relation to flooding, if we take one of those dimensions, which is that currently 1 in 5 properties are already at risk of flooding or coastal erosion. And this is actually set to move to be 1 in 4 within the next 15 years. And that's in addition to 1/3 of our roads and rail today, moving to 1/2 of our roads and rail in the same time frame. So I think what's really critical in terms of the way we approach the challenges, really moving away from anything that might feel or look like sort of a fluffy nature risk issue, if I can put it in those terms. For us, this is a fundamental risk, posing as one of the most significant threats to economic stability facing us in the UK. So flipping on one more, please, Alex. So we focus on water risk because it's really tangible. Nature loss and physical climate risk through the lens of water can be tackled through a business case for action. And we'll look at some of the figures. So you can see on the left here, Network Rail has paid out over £300 million in compensation associated specifically with flooding, disrupting operations. Businesses like Tesco, like the store you can see on the right here in Carlisle, are increasingly seeing a 10x increase in previously forecast flood risk. So that means flood risk, for example, that maybe used to be 1 in 30-year flood events are now being endured every 3 years instead. And when flood events hit, whether from rising river levels or surface water flooding, the business disruption is very tangible. So in this case, not just 8 weeks loss of revenue relating to the store closure, but asset depreciation or total loss of assets, costs of goods not sold, non-viable maintenance costs, rising insurance premiums. These are all costs which are already hitting bottom lines and pose critically as unpriced risk in the portfolios of many investors. So if we flip on one more slide, Alex, thank you. At a national level, what that means is, in terms of estimates, that we predict the economic impact of nature loss. It has been predicted to be 12% in terms of the decline of GDP if unaddressed. And we put it in these terms to help people recognise the size and extent of the challenge. This is more significant than the impact that we've seen, of course, from the global financial crisis and even from the COVID-19 pandemic. So we live in this new economic paradigm, which requires new systems and new models to address the challenges that we face. And we see nature markets as a critical part of this if we had to have really any chance of closing the funding gap for nature in the UK in an era, of course, of increasingly slashed government spending. So how do we do this? We move on. Thanks, Alex. At Rebalance Earth, so we seek to source and originate projects in which we can deploy funds to restore nature at scale in targeted ways that deliver and address really, really tangible business risks, be these associated with flooding, droughts, water quality, or, for example, a tangible ecosystem service dependency. And I'll share 2 examples along a spectrum, from the more straightforward on the one end to the much more complex on the other, to illustrate how this works. If you want to flip on, thank you. So one example is investing, for example, in the restoration of an oyster reef. So in this case, you have, for example, one nature-based solution designed or able to deliver, in fact, multiple ecosystem service benefits. But in this instance, primarily designed to tackle the decline in fish stocks and marine life in the North Sea. Going back, 100-200 years, actually, our native shoreline used to be covered in oysters. But last year, oyster reef populations collapsed in Europe. And beyond this being a very sad state of affairs, this presents a really identifiable threat to profitability for companies like Nestle, whose Purina pet food brand represents essentially a fifth of all of their revenues. Who knew? So this is a £20 billion per year business, heavily dependent on sourcing generally bycatch from the North Sea as a key input into their cat food predominantly. So in cases like this, you've got a scenario where declining fish stocks threaten the viability of a really high margin business, and that is why Nestle are incentivized to proactively restore nature using nature-based solutions, in this case an oyster reef, which enables and acts as a mechanism to enable the recovery of fish stocks, providing a really critical breeding ground, for example, for fish nurseries. So really, great example of very clear dependency and some very clear outcomes. On the other end of the complexity spectrum, we work on catchment scale initiatives, and this is really where we see the true scale of impact being feasible and possible, albeit with some complexity along the way. So in this example, we have an MOU, Memorandum of Understanding, in place with Plymouth City Council as an example to focus on how we can restore the surrounding area of the River Plym, predominantly again to address flood risk to the city of Plymouth using natural flood management techniques. We have an in-house platform called GPAP technology that we built, which enables us to map and analyse where flood risk impacts commercially high value areas in the UK. And then what we do is we look at where we can deploy nature-based solutions to tackle those risks. So for example, restoring rivers, restoring wetlands, riparian tree planting, and generally a whole host of others. So in this example, you can see on the screen, flood risk as it stands would impact a significant number of businesses, hundreds of kilometres of roads and railway tracks, in addition to electricity substations providing power to the entire region. So in projects like these, a whole portfolio of nature-based solutions may be funded and deployed, with the primary aim of delivering flood risk reduction, but oftentimes also water quality improvements, biodiversity net gain, and carbon sequestration would be other forms of outcomes through this type of restoration work. So we deploy the capital to fund the restoration, then we collect payments for the resulting commercial outcomes, generally from a buyer's club of commercial beneficiaries. So we move on. Thanks, Alex. So if we look at how we span, therefore, both land-based and marine nature-based solutions, I think what is absolutely fundamental is that we can identify in our projects a viable set of returns mechanisms for our investors. Now, our investors, they are typically long-term investors, such as local government pension schemes. We're really proud to be part-owned by the West Yorkshire Pension Fund, who also are the source of our initial £25 million seed fund, which we are actively working to deploy at the moment. And through that, we are building a portfolio of nature-based solutions across a range of projects which seek to deliver a diversified portfolio of uncorrelated returns for our investors, and we target an 8 to 12% IRR over a 15-year initial fund. So the income pathways and the returns mechanisms in our model span some of those that Emily made reference to: payments for ecosystem services, biodiversity net gain units, and carbon credits. And the blend and balance of these varies from project to project, depending on the specific ambition and the design for that project. Critically, we argue with investors that since nature is the foundation of pretty much everything, investing 2%, for example, of your portfolio to protect generally the remaining 98% would seem eminently sensible. And within the UK, this would deliver, in fact, the funding needed to meet our 30 by 30 goals over the next decade. And then last but not least, my final slide. Thank you, Alex. So what's critical is that regardless of the project origination, so it might come from customers we're working with, catchment scale initiatives that we either originate or join, or project developer-led projects, all of the opportunities we analyse are evaluated against this full returns framework. So as I mentioned, number one, fundamental, we can identify viable returns mechanisms within the scope of the project to hit the requirements for our IRR goals. But we also look, of course, for measurable net positive benefits, both for the environment, so natural returns, as well as for communities, so social returns as well. And we proactively seek, of course, really positive place-based impacts, which generally align really, really well with how local government pension schemes also want to invest. Not least, we seek to prioritise projects that offer what we call inspirational returns. We're aware big parts of our model are quite new. We want to build a blueprint that is scalable and replicable, that can be copied and hopefully advanced also by others. And within that, collaboration is absolutely essential. So we work with a variety of other organisations along that value chain, such as with Luke, who you're about to hear from next, at Nature Broking, organisations like Zulu, and you'll hear from Ed shortly, as well as local and combined authorities to deliver a viable model in which nature can become truly an investable asset class and hopefully therefore unlock the funding at scale required. So on that note, probably a good time to hand over to Luke. Thank you.
So I'll just add in a few words there. Thank you so much, Anne. That was brilliant. The back of my mind is, okay, so what are these projects, or which of these projects that do offer that 12% IRR? And would it not mean that all the investors are just going for those projects, obviously, but we can talk about that a bit later on. So over to you, Luke.
Brilliant. Excuse me. Thank you very much, and thank you very much, Ciara, for organising this, and the panelists as well for providing some amazing slides so far, and I'm very much looking forward to the future. I guess, I mean, the reason we're here, so we are a carbon credit and natural capital intermediary, Nature Broking, and what we look to do is to connect the supply, i.e. the projects that are being made, with the demand. And what we found is that a lot of the time people focus on the supply, and we talk about the integrity principles in order to be able to manage that, and ultimately forget about the demand, which is we must have demand in order to make this a viable market. If we could slide forward a slide, that'd be fantastic. So here we have Jargon Buster. Just really quickly, let's look at what is and what are carbon credits. So we focus very much on the carbon credit side. We're very much connected and focusing on the UK because at this current point in time, the UK carbon market is probably the most liquid and viable at this point, while we build out further ecosystem services market that come from that. So BNG is obviously statutory, that's being worked on. Payments for ecosystem services is a new model that we're working on understanding and getting better at. But for the purposes of this kind of conversation, I'm going to focus on carbon credits. So what is a carbon credit as such? A carbon credit is a ton of carbon dioxide equivalent. But what is carbon dioxide equivalent? Carbon dioxide equivalent is in essence the warming effect of individual greenhouse gases prorated back down to what a ton of carbon would do. So for example, if you have methane is anywhere between 28 and 90 times more warming, has a higher 90 times more warming potential than carbon. So for a ton of methane being released, it's the equivalent of 28 tons of carbon. So if we were to mitigate that ton of methane being released, we would be creating the equivalent of 28 tons of carbon. Now, there's three types of carbon that you have out there. You have reduction, avoidance, and removal. Avoidance credits are where you protect something from releasing carbon into the atmosphere. Reduction is where you have an active intervention to prevent carbon from being released into the atmosphere. So, for example, peatland is a reduction credit. It's where you are actively intervening to stop carbon from entering into the atmosphere. And then you have removal credits. Removal credits are carbon credits that, as it says on the tin, but remove carbon from the atmosphere. Now, I think it's really important to understand why companies would buy these. There are three kind of mechanisms that we see at the moment that are in the market that have been kind of looked at. The first was carbon neutrality. That was seen by organizations. It's sort of detracting in its favor at the moment, that idea of the polluter must pay, which is where a company can offset their emissions by purchasing carbon credits equal to the value of the credit of the tons of carbon that they are releasing into the atmosphere. Now, we know that that's not perhaps the right move at the moment, but ultimately within the UK, there's lots of standards that approve carbon neutrality, and increasingly it is important to get, well, not increasingly, it is imperative if you are going to claim carbon neutrality that you get a reporting to be able to do that. You have, you utilize a standard. Then you have beyond value chain mitigation, which is essentially where you decide to set an internal carbon price. And within that, you choose to pay some money towards helping society decarbonize. So almost like a philanthropic gesture. And then the last is net zero. Now, every business in the entire world will need to be net zero for us to achieve our net zero target of 2050. And that's an absolute must. There's a whole host of kind of different things that can be done, offtake agreements, support purchases, but I won't touch on that at the moment. So the reason I explain this, because I think it's important to provide a base level of understanding into what we're talking about here, so that we can understand what is going to drive corporates to be purchasing this. I think Anne's given a fantastic explanation of the risk side and the cost to businesses if we don't do this. What I'm going to try and do is look at this from the microcosm of corporate sustainability journeys and how they can then invest in these in order to be able to mitigate against business risks that are internal to their sustainability journey. We could go on to the next slide, please, Alex. So what is net zero? Well, ultimately, it is reducing your carbon emissions as an organization down from 100%, your baseline year, down to 90%, ultimately where you can go no further to reduce your footprint. During that time, while you're still polluting, during that decarbonisation journey, which can I just say is the most imperative thing that you can do as an organisation, is reduce the emissions going to your atmosphere. And ultimately, once you get to net zero, you should be looking to plan for that. Once you receive that, you can go no further. You will, as an organisation, have to purchase carbon removal credits in order to mitigate your residual emissions. So, as I say, I come back to, and if we could go to the next slide. Every company to reach net zero will need to use carbon credits. So fundamentally, there is a huge and growing market, as Anne said, that is expected to reach somewhere between, oh no, sorry, that was Ciara who said, somewhere between 1 to 1.2 billion per annum by 2030, and many times that size by 2050. So this is a captive market. Now, what we're seeing, if we could go to the next slide, is the drivers of why you'd invest in nature-based solutions within the UK. Ultimately, you have your net zero journey, and ultimately the price of carbon credits are going up significantly at the moment because we're seeing a drop in supply or high quality supply, and the UK has really, really good projects, but not a huge number of them, and then a huge increase in demand as we go towards 2030. Now, just straight supply and demand dynamics will then drive the price per ton up, and if the price per ton goes up and you can't achieve your net zero journey that you've committed to, you as an organization have made that commitment, then ultimately you may be left with litigation where your buyers who are assuming you're going to make it are then going to sue you to say, I bought goods from your organization on the premise that you were going to be net zero, but because you can't afford carbon removal credit, you can't then do that. So ultimately, if you've made that commitment, it's now shifting to business risk, because ultimately it's down to your risk board who have said, okay, well, we've made this commitment. We were going to stick with this commitment, and we need to do something about that commitment. And as we said in the previous slide, you will have to buy a carbon credit if you've made a 2030 net zero commitment, 2040 or 2050. There's a whole load of other stuff, and I think we've looked at the policy side. Regulation is increasing. There's more and more drivers. The UK government has just released a consultation on the UK carbon market and how to drive investment into nature recovery. This can be linked to the kind of benefits, so benefits to employee satisfaction, competitive advantage. We know that companies that invest in their ESG and are more ESG friendly get a lower cost of debt, which is really, really useful. They also get increased brand value, and they grow quicker, normally somewhere between 6 and 10% faster than their non-ESG friendly compatriots. So it is a business imperative to be investing in the sustainability. Ultimately, there can be cost savings. So as I say, if the price per ton is going to be very expensive in 2030, if we bring it back to today, ultimately it's a lot cheaper. So it's a good way to hedge against future price risk. And then the last bit that feeds into it is that if we look at all forms of sustainability from an organization, we've been looking at it for too long as a cost. So ultimately, every business puts in sustainability as a cost on their profit and loss statement. Now, without getting too noddy, when people put that in as a cost in their profit and loss statement, ultimately it affects profitability. And then as an organization, it is affecting your ability to raise capital because you are a less profitable business. It also affects your share price. And what we've seen some organizations, for example, BP, moving away where their share price did not reflect the value that they were investing in terms of their net zero and sustainability journey. And actually, that then detracted from them and has meant that they've moved away from their investments. BP, as far as I'm aware, stands for Beyond Petroleum. It doesn't stand for British Petroleum anymore. They rebranded in 2021 secretly, but we're seeing that sort of go back. And that's coming from investors who are wanting to see this. Now, if we can flip that narrative and create assets, so by buying carbon credits forward, for example, for your net zero journey, you're creating assets that accrue value. And this is how we can change the narrative, which is how do we turn a cost into an asset? And that's some of the work that we're doing at the moment. I won't dive into the noddiness of it, but if anyone's interested, I'm more than happy to share some slides about that. You go next slide. So what are the drivers? Why do companies want to buy all of these kind of things, which is, as we see here, internal drivers. Employees want their customers to invest actively in sustainability, want their company, 69%, and 30% of consumers are compelled to move away. So it's a business risk by not investing in sustainability. And as such, if we flip this back, then not purchasing carbon credits and investing in nature in the UK, and it'll be done. If we look at the direct drivers, we've got the SBTI, which is looking at creating requirements for using removals, and the UK government, as I said, has a consultation. In the NHS, which has a huge supply chain, we are seeing organisations being pushed to showcase their sustainable credentials, including 10% for social value. That 10% for social value is a public procurement, or PPN, social value model, as you can see here, which is telling organisations to invest in their local community, invest in nature. And then we have TCSD and then CSRD and CSDDD in the EU. So these drivers are forcing companies to look at more into how they can be more sustainable. But as I say, if it's a cost, then they will do it at the most economically available way of doing that. Whereas if it's an asset, we're creating value. So we do a lot of work as an organization, which is to drive demand in the natural capital markets within the UK. Ultimately, we have to start looking at this as a financial services market and taking an innovative financial services mechanism like diversification, like hedging against future price rises, and bringing it into the corporate world to help unlock that asset value that is nature. Thank you.
Well, that was fantastic. Thank you so much. Thank you so much, Luke. That was great. Do you want to do the slide?
Why not? Yeah, no, that would be good. I completely forgot I was doing one more slide, perhaps. So ultimately, if you're then investing in assets, creating assets, again, due diligence and getting information about a project is really, really important. And what makes a good, what ultimately makes a good credit, whether it's a B&G credit, and I think this is really important because ultimately, when you sell the environmental attribute as a project into the market, it has to deliver on a risk threshold as well as an impact threshold. So how do we create a low risk project? Ultimately, it needs really good governance. And in order to get good governance, you have to look at sort of, roughly speaking, about 20 facets. So you're looking at the carbon facets, which is your additionality, your double counting, your governance, and your environmental safeguards. So what is the project doing? You also have to look at the social safeguards. So how is this going to be created over the life cycle of a project, maybe 40 to 100 years? What are the quantification methodologies? And then actually looking at further than that, some of the other elements of it, which is how good is the project developer? How long have they been working? Are they going to be around? What's their documentation going to be like? And what we do as an organization is take all of this and gets it into a risk score so that the businesses that we work with can really understand the projects, the transparency of the projects that sit underneath it. Because the carbon market and the nature markets as a whole have been relatively intransparent because they're new and emerging markets. And then on the flip side, what this allows is us to be able to go to projects and say, these are the things that you need in order to be working with an FCA regulated business. Because at the moment, we see a disconnect between projects that are doing incredible things on impact, but lack the governance and the risk appetite and thresholds to be able to translate that into a project that is investable from the point of view of a corporate. And that translation layer is really, really important as we go through this. Okay, now I'm done. Thank you. Sorry, I forgot about that last.
Well done. Well done, Luke. That was fantastic. And also thank you for setting the context with your jargon buster. A couple of weeks ago, I read about Total Energy and Shell that they publicly disclosed they will buy and retire 100 million carbon credits to balance their 2030 plan. So presumably that's the residual emissions point. So we're seeing a huge demand from corporate buyers, investors, going to what Anne was saying, local authorities and their sort of different hats that they play. Is there the supply of projects? And I think that is something that Ed will talk about because he'll be thinking more about these projects from a landscape scale. So over to you, Ed. Thank you very much.
Thank you. Thanks, Ciara, for having us all and organizing this event. Fantastic event. So, as Ciara mentioned, I'm going to be talking a little bit about how do we put these programs together? How do we address that challenging return target that investors such as Rebalance and others are setting? How do we address this issue of quality? How do we bring together what is really a very complex environment? Lots of regulations, lots of complexity around nature, lots of people involved, lots of different stakeholders. So I'm going to talk you through a little bit of a case study around how we've been approaching this for a specific landscape, working with Severn Trent Water, not too many miles south of the Great North. And we are also, I'm going to be just setting out initially a little bit about how we think about different sources of demand and funding as well for these programs. Maybe a little bit less, more higher level than some of the things we've heard before. So just quickly, I'll jump into kind of who we are and what we do. So very quickly setting the scene, we're basically a team of about 30 people. We're a group of people who are scientists, land managers, experts in woodlands, peatlands, soils, etc., ecologists, but we're also importantly tech and product specialists, and we're commercial specialists. And really what we've sought to do is to sort of blend all of these different disciplines together in finding solutions to these problems. What we do is we deliver solutions end to end. So we start with understanding what is the land, what is there, and what does the land want to be from a natural perspective, but then also looking at designing projects, delivering those projects, and then monitoring outcomes and realizing value, importantly, from those outcomes. So we're very much working end to end, trying to solve problems at each stage. And importantly, we work at property scales, but we also work at landscape scales. And so that's what I'm going to be focusing on more today, is that landscape aspect. So a little bit about nature markets and funding. So I think in a sense, what you've been hearing about is lots of different aspects of this. So Luke has talked a fair bit about the voluntary market side, the carbon markets, which we hear a lot about, Woodland Carbon Code, Peatland Code, and so on. We talk about here about Vera, Red Plus. All of these are essentially examples of the voluntary carbon markets, and they're driven by companies setting themselves carbon net zero objectives. And there are also companies setting themselves biodiversity targets in that sort of voluntary biodiversity crediting market, but it's still quite early, and these are relatively small pools in terms of where we want to be. There's also a very significant driver around compliance and regulation, and these are driven by policy drivers, and they tend to be much more local, but these are things like nutrient neutrality targets, BNG, species conservation objectives around planning, water regulations, and so on. And there's actually quite a substantial amount of capital going after those, and typically I would say is already significantly bigger than the voluntary market in terms of where the capital is. And then you've got, and ultimately this is where we want to be, and we were hearing a little bit about this earlier around, where is the real strategic driver? Really helping businesses and public sector and frankly everyone to wake up to the strategic value of nature, the fact that our food supply chains wouldn't exist were it not for pollination services, and a significant risk, as we heard, in relation to flood risk, drought risk, and so on. There's business continuity risk, whether it's railways or highways getting washed away, or whether it's supermarkets getting flooded, or whatever it might be. These are examples of business continuity risk, and they have value, and they cost money to insure, and so on. So these are the examples of strategic risks that are increasingly coming into focus, and which are underpinning, if you like, demand for nature-based solutions projects, and this recognition that nature is really at the heart of helping us adapt to climate change and to some extent to mitigate its worst effects. Now, fortunately, there are investors, and Rebalance is a great example of this, of investors coming into this space and recognizing that where there is, if you like, as these markets are growing and evolving, that in a sense they're looking to invest ahead, and investors are very good at investing into emerging markets, and this is an example of an emerging market. So these investors take many forms, and so you've got people who are, for example, pension funds, as we heard, but there are also people who specialize in specific aspects of nature, forestry, agriculture, for example, and they've been there for a while, but their profile is growing and they are increasingly attracting capital. At the other end, you've got people who are just into real estate and who see, for example, natural capital and natural capital projects as another kind of special example of a niche sector within real estate. And they look at it differently. They evaluate potential projects differently. They have different ways of evaluating risk. Another example is venture capital, people who are investing in tech and other players who are, for example, solving problems within this space. And that would be examples of people who might invest in a company like ours or in others as well. So these are the sorts of examples of players in this space. And I won't go into a lot of detail on this, but the important thing is that the investment market only really exists if you believe that the underlying marketplace exists. So ultimately, it all comes back to this diagram. Is there a market there? Do people recognize it? If there is, then you can make the case for these investors and recognize that ultimately you can achieve returns. So what does that mean if we're sort of targeting investors and sponsors and others into this space? How do we think about them and what are the different ways of approaching it? So in essence, the real challenge here is matching the different sources of demand and funding into this really quite complex supply. And so, we've heard about lots of different types of project, whether they're carbon specific or nutrient projects or NFM projects or BNG projects and so on and so forth. And then we've also heard about these different sources of demand. And the challenge is that projects are not generating just one type of outcome, and the different sources of demand are not looking for just one thing. And so we're in this quite complex mixing and matching problem. And the other problem is that the investors who are looking for a sort of 12% IRR are unlikely to get it if they're only valuing one dimension or one aspect of a project. So a woodland project is not just producing carbon, it's also producing biodiversity. It may also be generating improvements in natural flood management. There are many different things, amenity value and so on, cultural value. And so these are all important outcomes. And if we're going to provide the returns that investors require, we need to find a way to match those different outcomes to these different sources of demand so that we can achieve that aggregate level of return at the project level. So how do we think about this and how do we go about it? I think the first thing is, and if you take one sort of thing away from this, is it is complex and you do need to know your audience because they all want slightly different things. And perhaps one of the reasons why it's so confusing is because there are so many different partners and players in this space. So the first thing is, and I've tried to keep it relatively simple, but frankly, it does boil down to more or less these 3-4 things. So the first thing is, what is it that the investor or the sponsor is looking for by way of an outcome? And it may seem quite simple, but in fact, even within a given, and we speak to specific investors, for example, or investors in this space, and even within the same organization, they may have two funds with different objectives. One, for example, that is looking to invest in projects that will provide, let's say for the sake of argument, carbon credits for their investors, their own investors, and another fund which is entirely focused on providing a financial return. So it's very important to be clear, is there a cash or some other impact? And indeed, obviously, if you're looking at different investors and sponsors, they have different specific objectives. And if you can't provide them that specific objective, then frankly, they don't care. They ultimately can't make a decision, however nice your project. The second is around risk and return. So what is their appetite for risk and what is their target rate of return? And again, if you can't fit that kind of round peg in the square hole or whichever way around it is, then it's just not going to work. So we really need to figure out, is our project matching their risk and return profile? And if not, the chances are you're going to be pushing water uphill. And then also importantly, time horizons. So different institutions have very different ways of looking at time scales for return on projects. Now, as we know, nature is essentially open-ended, and a lot of these projects, have very long-term horizons. Now, it's fortunate that some do generate returns in the short term, but it's very important to understand your investor and sponsor and what their horizons are. And most investors are typically time bound, and so they might have, for example, a 10 or a 15-year window on an investment fund, and that means they've got to figure out how they're going to make a return within that window. So it's no good saying to them, don't worry, in 2074 you will get your money back, if they need it back in 2035. So another thing that's important is that different investors have different levels of expectation and understanding about staging of projects, and are much more comfortable coming in at different stages. And this is a key part of how they manage risk. So a typical real estate investor might be happy coming in at the stage where it's still very unclear who owns the land, what exactly is the status of that land, are there tenancies involved, does it need a clean up, is it sort of bound by regulations and other things. And so really kind of getting that piece cleared up is almost the first thing you want to do when you're evaluating a project, is kind of who owns the land, is the land even available for this project. The second is, what is the project? How going through all the process of designing, scoping, costing, grant applications, consultations, and so on. That's an important phase, even before you've actually spent a single penny on actually putting up fences, planting trees, doing land works, etc. There's a whole process of what we call project development, which is really just to getting it to the point where it is actually, for many investors, investable. And most investors who are investing in this space will only really be interested in coming in after this stage. And that's what we call the sort of project delivery phase. This is your classic project funding, project financing phase, where everything's all lined up, it's all very clear. Everyone knows what they have to do. The funding drops, and then you go ahead and you do the work. And you get the project to the point where it's essentially validated in whatever form that takes. And then over time, the project is delivering, if you like, the outcomes. And that is, if you like, the offtake stage. It's the point at which you've got credits or other things that are coming through. And at every milestone, you've got some sort of verification mechanism that says, yes, we've confirmed that this outcome has been achieved, and you get paid essentially for providing that outcome. So the point is that some investors are very interested in coming in very early in that process. They like the fact that they get more control, more influence, but they're taking more risk, and they therefore expect a higher rate of return. And there are those who are happier coming in at a later stage. And this may seem very obvious, but it's actually surprising to me how often people sort of fail to really grasp this when we're talking to them. So let's talk about landscapes. So why landscapes? I think, first of all, they're very important, and they're quite hard to do, but they're very important. And why they're important is, first of all, the whole is bigger than the sum of the parts when you're talking about landscapes. Think of a mosaic. I can give you it's very different to have a nice, pretty picture, and it's a completely different thing having a pile of tiles. So in a sense, that picture only appears, that value only kind of comes through when you're looking at it as a whole. And ecosystems really work on big scales. Scales also bring economic efficiencies, and both for the investor, the sponsor, but as well as the stakeholders and others. And so everyone prefers bigger scales and their big productivity gains. And then there's an optimization challenge at landscapes, which you can't really do at the individual project level, which is about balancing different stakeholder priorities. We can't put all of our land into nature. We have to think about food production. We have to think about car parks and playing fields and schools and hospitals and renewables infrastructure and all these other things. So we need to look at optimization of land use, and indeed, and you can only really start to do that at the landscape scale. So the specific approach we've taken is one which we developed with Severn Trent Water, where they were really looking to solve this. And what we did was we said, let's think about how do we solve this challenge. And so we looked at, first of all, the question of what are the types of intervention that you could do in a given landscape. And in this case, the landscape, the unit of landscape we used was essentially a catchment. This is the idle catchment. It's around 1,000 square kilometers of land, 100,000 hectares. And so we asked ourselves, okay, well, what types of, if we were to do nature-based projects in this area, what kinds of nature does the land want to be? And so we looked at it through a woodland creation opportunity lens. We looked at it through a sort of pond creation lens. We looked at it through various biodiversity net gain lenses and various other habitat types and so on. And I won't take you through all of them, but the point is that there's a sort of intervention opportunity way of looking at a landscape that's very important, because ultimately it's about right tree, right habitat, right place. But there's also an impact dimension. And this is where you're starting to look at, well, can we create nature corridors as a biodiversity, as a sort of one measure of biodiversity, for example? You could look at that from a flood risk perspective, or a drought or other perspectives. You can look at it from a water quality or nitrates or and other perspectives. So there are many different ways one can look at impact at a landscape scale as well. And then you can also look at it through other lenses, things like grants and availability of grant funding, or opportunity cost in terms of and competing land use when you're talking about agricultural land quality. You can look at it through different regulatory designation lenses and so on. And the important thing is not to sort of, in a way, just look at it through lots of data lenses, but it's really then to pull all this together into a so what. And the question around the so what then becomes, well, we've got all this data. What do we actually care about? What are we trying to achieve? And I think the key insight here is that it depends who you ask. And those of you that work within local authorities will understand that really you've been set an objective around, say, local nature recovery strategies, or you may have certain planning objectives, or you may have certain, other specific objectives. And even within your own organizations, there may be different views about what the priorities are. And therefore, there are different demands on what the landscape can be or should be. Similarly, you will have certain corporates who will be driven by ultimately, say, for example, carbon and biodiversity net gain. You may have food producers who are particularly driven by agricultural production and maybe water-related outcomes, particularly as they relate to natural flood management or drought. So the point is that different stakeholders will have different objectives. And why does that matter? Because your spatial maps, your spatial optimization differs depending on what you're looking for. So if I have a map that is optimized for carbon biodiversity and water, for example, and the availability of grant funding, it will look something like this. But if I don't care about carbon and I'm increasing focus on agriculture, it'll look a bit like this. So in a sense, the point here is that different stakeholders have different views about what they want in their landscape, and therefore we can construct different approaches to funding and to indeed landowner engagement and project development based on those priorities. What then happens is taking it down to the ground level and saying, well, okay, who cares and who's actually going to make this work? And this is where it gets really interesting, because then we start to take it down to the specific landowner and the specific corporate or other institution who is impacted. So here we're starting to sort of zoom in, if you like, on the detail and identify individual stakeholders on the demand side. And then really designing projects that match the needs of that demand stakeholder or of that particular impact dimension. So we match the project to the demand, and then what we do is we quantify the impact of that particular project in that particular location on that outcome. So ultimately, and perhaps ultimately what it all boils down to is quantification and really matching the specific nature program to the specific stakeholder via a specific metric that they ultimately care about. And so whether you're talking to a demand side corporate who values, and we heard about, whether it's, National Rail or others who are caring about keeping the trains running on time, and that's their key metric, or whether it's a specific institutional investor looking for an IRR return, or a landowner who wants to know, what's in it for me, you've got to ultimately break it down into these different quantifiable outcomes and make it specific to the project and to the location. So I will stop there because I appreciate I've been talking at quite a rate of knots and probably communicated a lot, but happy to take any questions when the time comes.
Great.
Thank you.
That's fantastic, Ed. And I'm very pleased that you are indeed a reformed banker. Because I think your insights you shared there were really very useful. And I don't know what the audience are thinking, but there are so many different aspects to be thinking of all at once. And luckily, there are some very good software technologies that can help you think about this whole different sort of ecosystem of demands. But I was particularly interested by what you were saying in terms of, the different types of investors and the different stages that they come in. Krista, so over to you. And thank you so much for joining us. Krista, you will be talking about supporting the emerging BNG market from a GMCA point of view.
Yeah, thanks, Ciara. And yeah, great presentations so far. There's lots of hooks and replicable messages that I'm going to kind of come out here. But what I want to do is just do a bit of a deep dive in terms of what we're doing in Greater Manchester and how we're supporting the growth of a local offsite BNG market, and particularly supporting our local authorities. So next slide. We previously presented at previous webinars that we've held, and so I'm not going to kind of go through all the slides again, but I think I've just pulled up two slides, this first one and the next one, in terms of how we've kind of started our natural capital journey. And that kind of began quite a few years ago when I joined the Combined Authority in 2016, how we were starting to look at building a set of natural capital accounts, and ecosystem services opportunity map. So it's great to see Ed's kind of visuals there and use of technology. I think ecosystem services opportunity mapping has come a long way since kind of we started kind of dabbling our toes in the water there. So I think it's great to see how technology is really kind of enhancing how we can use these outputs. But what happened from all of that work really is we were looking at how we can look at kind of winding that net in terms of not only just focusing on kind of public funded projects for nature, but how we can widen that net to kind of include private. And so one of our kind of key steps, first of all, was to produce a natural capital investment plan, and that kind of identified a range of opportunities for us to kind of look at how we kind of focus on various different kind of investable propositions. And I think the key kind of recommendation from natural capital investment plan, which I think is really important, is around kind of investment readiness and the need for that kind of investment readiness funding to actually get projects over the line, and actually to kind of provide the capacity, the resources and the skills that are needed to actually get those business cases over the line and out to the market and sell whatever product they're doing. And without that kind of investment readiness funding, we're not going to see that kind of wealth of and range of projects that are kind of coming forward. So next slide. And as part of the work that we did, we then kind of set up, one of the recommendations from Natural Capital Investment Plan was to set up some form of investment mechanism. So next slide, please. Thank you. So basically we commissioned Finance Earth to produce a natural capital investment strategy, and that natural capital investment strategy formed the basis of us setting up the GM Environment Trust, which is an arm's length independent charity from GMCA, run by Lancashire Wildlife Trust. And the key aim of that trust is to kind of act as an umbrella in Greater Manchester to aggregate projects, but also to kind of look at how we take forward various different investable propositions in the short term, kind of carrying on from that focus on pump priming, public and philanthropic grant funding, but starting to widen the net in terms of corporate funding programs, particularly through our waste disposal contract with Suez, that's kind of looking at delivering its community recycling funded program So there's a kind of pot of money there that communities can bring forward their own local recycling projects, but also the Green Spaces Fund that the Mayor's put 2.3 million into over the past couple of years and funded 103 community green space projects. So that's some of the kind of non-repayable funding, but also the repayable funding, you know, in terms of investment that we're looking at. Are the kind of two key models are around habitat banks through BNG, but also carbon, but also kind of wider stuff. And, you know, kind of Emily mentioned about the kind of the whole map of the Northwest in terms of various different things going on. So through our integrated water management plan, looking at, you know, kind of natural flood management, etc., but also kind of looking at how we kind of widen the net in terms of the built environment and our kind of carbon requirements of new developments coming in and offsetting their carbon requirements. But what I want to do today is just focus on the BNG side. So next slide. I don't know whether I can change it myself, but so obviously, you know, kind of most of you be familiar with, you know, mandatory biodiversity net gain kicked in a year ago, requiring a 10% uplift in developments displacing habitats. So they have to replace what they've displaced, but also 10% on top of that. And actually, interestingly, new government consultations have come out today on the requirement for BNG for nationally strategic infrastructure projects, but also for small to medium brownfield site developments, which I think is going to be quite an interesting kind of development in terms of addressing some of the bottlenecks around BNG. But obviously, if you can't deliver, if developers and developments can't deliver on-site, they need to purchase off-site units. And obviously, the key priority is to deliver on-site, and the mitigation hierarchy has a priority around on-site first. But obviously, if you can't deliver on-site, the priority then is to kind of look at off-site. And, you know, the market for off-site BNG, developers can either choose to purchase BNG off-site units from the market or go to a national set of credits. And in Greater Manchester, the off-site units kind of market's developing, but it's kind of emerging. It's happening quite slowly. So we are seeing some private habitat bankers coming forward, particularly through Environment Bank, but also Green Earth Development that have been bringing forward their sites. So we've got some, you know, kind of third-party private habitat bank operators already kind of providing sites in Greater Manchester. But from a Greater Manchester perspective, we want to kind of ensure that that those units stay within Greater Manchester, that actually, you know, particularly in terms of from a kind of local impact, in terms of those local communities impact by development, that they benefit from those benefits from off-site units, but also that we are kind of ensuring that actually we're stimulating and supporting the development of that local market. Obviously, local authorities can't force developers to buy from within Greater Manchester, but what we can do is try and create the conditions that there is a supportive element there that helps kind of to support that market, and whatever we can do to help support that market grow and provide those locally based units, then that's great. So there are kind of the main rationale for that really is that we want to create and restore those habitats close to those development sites and within those communities that are affected by development, but also deliver those wider benefits to local communities. So again, that additionality point, you know, it's not, you know, it's about biodiversity net gain, but it's also about access to green space, it's about health and well-being, it's about natural flood management, it's about carbon, etc. So how do we deliver those wider benefits, but also how do we prioritize those areas that are coming forward through our local nature recovery strategy? So we're due to be adopting our local nature recovery strategy in the summer. That identifies a range of opportunity areas. How do we kind of ensure that kind of sites are coming through there for biodiversity net gain? And obviously, there are two key roles here in terms of local authorities playing an active role in terms of supporting the local BNG market. There are two ways they can bring forward their own sites for off-site BNG, but also they can help facilitate third-party sites to come forward, particularly through signing legal agreements, Section 106 agreements with those third-party sites to enable them to get their legal agreement in place that they can then register their sites on the national register. So a really important piece of work that we commissioned last year and was developed by our Greater Manchester Ecology Unit was a need and supply assessment. And again, you need to understand, first of all, when you're going to come into this market, well, what is the need for off-site B&G units. And again, we've got our Places for Everyone plan and our 10 kind of development plans that our local authorities are bringing forward that have site allocations in there for new housing development and other kind of commercial development. So how do we kind of get a better understanding of, well, how much of those sites can deliver on site, but then importantly, how much of those sites can't deliver on site and need off-site units? So we produce this report, and also we produce a report that actually kind of captured, well, what are the supply sites out there? What are local authorities sites looking like in terms of potentially bringing forward off-site B&G units? And we managed to kind of whittle a whole range of sites out there down. So we've got a good idea of what's the need for and what's the supply, but that's constantly changing. And I think the key point here is you need to really kind of, there are some assumptions built into that needs and supply assessment, but that constantly change. And we're having to kind of look at, well, what are the patterns emerging from developments coming forward? How many developments that we're delivering on greenfield sites can actually deliver on site versus off site? And that those kind of patterns are kind of constantly changing. So so it's important for us to kind of explore, potential for local authorities to bring forward their own sites. And I think Emily again mentioned about the Natural Environment Investment Readiness funded projects. And again, we had 2 rounds of natural environment investment readiness projects. The second round was focusing on how do we kind of provide an overarching GM investment platform for local authority sites, and local authorities bring forward their own sites. So the key kind of 2 actions within there, supporting specifically, local authorities to actually kind of bring forward their own sites and capturing that learning that could be shared with other sites. So we've got a range of habitat management plans that have been costed up for a number of sites in Greater Manchester that just helps those local authorities get onto the next stage of the ladder in terms of bringing forward their investable proposition, but also holding workshops with the other authorities that haven't got specific funding to bring forward their sites to share those lessons learned, challenges, etc. So again, we've got all of that work that's been kind of taken forward. And in addition to that, what we've also got is, I mentioned before about local authorities supporting third-party habitat bank providers to bring forward their own sites by signing a Section 106. Well, local authorities also need, if they're going to bring forward sites, need legal agreements in place. They can do that. If they're going to lease their site, they're kind of, whoever they're going to lease to can sign a Section 106 with that local authority, but local authorities can't sign 106s themselves with each, kind of between themselves, so in terms of their own local authority. So they can't sign a Section 106 with their own authority. They have to either go to a reciprocal authority or lease out their site. The other alternative is to sign a conservation covenant with a responsible body. So there are a range of responsible bodies out there across the country. Both the Greater Manchester Environment Trust and GMCA applied to be a responsible body, and they received their responsible body status from DEFRA, but are still kind of developing their proposals. So Greater Manchester Combined Authority, we've commissioned WSP consultants to actually do a more kind of detailed options appraisal of what actually our responsible body status would entail. Do we kind of just offer it for our GM authorities? Do we offer it to GM authorities plus neighbouring authorities? Or do we offer it to kind of local authorities plus third parties within Greater Manchester? And kind of recently, kind of senior officers through that recommendations in that WSP report have agreed that we kind of focus on our GM local authorities in the first instance to trial that, see how that goes. But we've still yet to bottom out the detailed costings for this, because effectively we have to sign up for a 30-year agreement with local authorities, and that's a kind of commitment that the combined authority will have to sign as a kind of quite a new authority. That's a long period of time, but also it will have to have a kind of dedicated person in place. So again, we have to do the kind of the financial viability costings around whether or not we can kind of provide a dedicated person over that long period of time, and how we financially secure those kind of money. So that's something we're working on. But also, we also want to ensure that, again, we provide this marketplace, whether that's for local authorities or for third parties. And I put up this slide here, which is the Gaia marketplace, which is this quite, kind of a really interesting, kind of concept that's come up, that actually any it captures all kind of habitat banks across the country that have been registered or coming forward based on information that's known. And so you can search the Northwest and you can bring up your own kind of list of habitat banks that have been registered. What we want to do in Greater Manchester is do something similar, and we want to have some form of portal that is available to regional buyers of biodiversity net gain units, that effectively they can go, right, we can see that that site is coming forward, let's say by X local authority, it's close to our development, right, let's go and have a chat with them. Because ultimately this is about ensuring that there's confidence in the market, that developers are knowing and knowledgeable of what's coming forward in the market. So currently the Gaia marketplace is predominantly focused on those sites that are registered or pretty nearly registered. Well, we want to ensure that actually there are early discussions happening before that, but obviously there are commercial considerations taking place. So my final slide really is that I think what the key point here is that I've shown on the kind of Green Finance Institute investment snake on that top right hand illustration, which shows the kind of steps that you need to go through in terms of any kind of business case for bringing forward a kind of nature based solution. And in the case of where we are in Greater Manchester, there's still quite a lot that's needed around engaging with the market to understand, well, actually, if a local authority is going to put resources and commitment into bringing forward a site, how do they know actually there's demand for that? So that where I've kind of highlighted with the red kind of circle is that kind of that engagement with that kind of buyer market is absolutely essential, because you can be quite speculative, you can spend a lot of money, kind of in terms of bringing forward a site, doing all of the habitat management plans, getting the legal agreements in place, and then kind of finding, well, actually, have I got any buyers here? So that is absolutely essential. So we're actually going to be commissioning some work soon to actually engage with the regional kind of buyers in Greater Manchester to kind of actually just test the water. Is there an appetite for local authority offsite B&G units as opposed to other units, whether or not that's within GM or outside? And therefore, what would developers or buyers kind of look for in terms of a local authority offer? And I've put the kind of illustration of the LNRS map on the bottom right hand corner, because that's absolutely key really in terms of our next steps in terms of implementation of LNRS and how we drive other investable propositions forward. This is setting the kind of blueprint in terms of where we're looking to improve our biodiversity in Greater Manchester, and obviously the LNRS provides a mechanism in terms of how we start taking forward projects forward. So again, lots of other LNRSs are coming forward in the north, and again, watch this space in terms of those coming forward and how they actually then are implemented, because the implementation, once they have been adopted, is key in terms of how do we look at building partnerships and collaborations to actually take them forward. So I think that's me. Thank you.
Wow, great. Thank you so much, Krista. I mean, really great leadership from the GMCA in all of this. And if there are other local authorities going, well, we're at a different sort of end of the curve here, worry not, because there is a lot of guidance out there. But I thought, given Krista's sort of leadership in this area, do any of the panelists want to ask Krista a question? We've got 8 minutes, so not too many, because I've got a few questions and I can see a question there in the Q&A section.
Is it possible just to take my slide off so we're all on?
Yeah. So Alex, you can take off all the slides so we can see all the speakers.
Well, thank you.
So any questions there for Krista? Okay. So let's then go to the question that's in the Q&A section. This is coming from David Wilcox. It's quite long, but what it's basically asking is, the biggest problem with supply is the concept of additionality. And the question is, it goes on to say that additionality prevents scale, limiting the size and impacts of each project and the total market. What is your supply solution for this built-in limit? David, I'm not sure who you want to ask that. So should we ask the speakers to talk about what they think about that question? So the concept of additionality. Projects that are highly scalable usually fail additionality tests. Companies, instead of organising projects at scale and merging their resources, are forced to choose smaller, unscalable projects.
I'll take it if you like, Ciara, just quickly. I think it's a challenge right now around stacking, right? So your ability to stack multiple sources of revenue from a given project is challenged if it can be an issue from an additionality perspective in the UK context, because you can't demonstrate that you wouldn't have done the project without it. So I think the short answer is yes, it is a challenge. I think it's particularly a challenge in the voluntary markets because in a sense you're asking somebody to pay for something that you would otherwise have done anyway. So it's a tricky one. I think the question is where do we go with it? My hope is that eventually we end up in a world where you get paid for outcomes, whatever, and you're not really getting paid to do work, and we're in this sort of slightly in between space where we're paying people to do work rather than paying for outcomes. So we will eventually be paying for maintenance and outcomes, which would be a different thing. But the short answer is it is a challenge, it is a quandary. I don't think there's a perfect answer to it. It often comes up,
Okay,
yeah.
That's great. Thank you. Thanks so much. Okay, we've got 5 minutes. I've been listening to all of the speakers and I really do want to thank them. Every single presentation was brilliant. But Emily, just to start with you, just in terms of, do you have any more details on creating a single pipeline for the North and how this may happen? What are some of the considerations?
Yeah, so this is something that Nature North is exploring alongside others. And I think that what we have is the potential to provide that supply. We do have a really large, across our partnership, we have access to a really large supply of potential nature recovery projects. I completely agree as well with that point around them being investable as well as impactful. And that's another area of work that we're looking at as well. It's no point having a massive pipeline for the north of England, which none of those can be invested in. So that's something else that we need to explore. And there's a huge amount of support work that needs to go into the nature delivery sector and individual projects to help them get to that point. So that's part of what building a pipeline would be about, is, you know, many of the organisations doing brilliant work at the moment, they don't have those skill sets, they don't have people in their teams who can do this, or they don't have the capacity and resources to even get involved with it, just don't have enough capacity to even think about investment. So that's a part of it. And then the other part is huge and very kind of detailed conversations around data sharing and who holds the data, how you can share that data, and how you can create a single pipeline that doesn't, you know, people have issues around confidentiality, and so we're exploring all of that. So it's actually quite a technical conversation that we're having, but the aim would be that for an individual project, what they would see is they simply sign up, and whether their project is eligible for a different kind of funding, then they can access that in a very easy, straightforward way, rather than having to sign up to multiple different potential, you know, projects and schemes for investment. Our aim is that eventually projects can simply go, oh yeah, we sign up for this, and if we're eligible, we'll get funding back through again. So that's how we're trying to aim to do it.
Okay, brilliant answer. So Anne, quick question for you, because we've only got 3 minutes. But in terms of this sort of lack of early stage finance or investor ready grant funding, quite a few of you have mentioned the NERF grant funding along with the sort of technical expertise that is offered. There are sort of philanthropic grants, which is great. But in terms of the risk management that you as an investor want to see, so from a local authority point of view, do they need to come up with a sort of a risk register, risk framework? What sort of risk management do you want to see when you're considering if this is an investor ready project?
Yeah, Ciara, that's a great question. I'm conscious of time, and I know I mentioned this to you previously, but we actually have an outline of what we would require to consider a project investment ready, which I'm very, very happy to share as a resource after the call for anybody who'd like to see that. I can send that across. But essentially, it's really depth of planning in regards to, an identifiable set of criteria that defines, of course, the outcomes of the project. As I mentioned, looking at what the sources of returns would be and how much thought and planning has really gone into that. These are areas where, in an ideal world, some of the funding routes that you've already mentioned, NERF, for example, would be one. We see others using grants from the likes of Esme Fairbairn to help them work projects up to the point where some of that analysis and that critical thinking around the design of the project, some of the things, of course, that Ed was covered well in his presentation, as well as then what does that offtake, what do the outcomes look like, how do you size that, how do we value those? These are conversations we often engage in as part of our exploration of projects, and we'd need to kind of double click and truly understand essentially how much data and analysis and research has gone into that. We're also quite pragmatic, and we recognise that there's a range of maturity realities out there in the market, and a big part of success really in this area is helping connect the dots between project developers and actually I think many of the people on this call in terms of the ways that we can support on really maturing the thinking and the depth of design and planning that are going into those projects, so that we can have a de-risked approach to our investment analysis by the time, for example, it hits our desk.
Okay.
But very, very happy to share that document that goes into a bit more detail on the points we would look at, and essentially what would be in the data room, what are the resources and the materials that we need. It's quite an extensive list.
Okay, well, I think definitely from an investor point of view, it's important that you get the last word. So thank you very much, and want to thank the audience for joining us, and apologies again about round one, but a huge thank you to all the speakers for sharing your expertise and what knowledge you all have. And just to mention, because we were going to talk about, discussing putting a price on nature, but I think it's pretty pointless with you lot. But to give kudos to the Indian banker, his name was Pawan Sukhdev. I think he was the guy who came up with it first. So thank you so much to everyone, and have a lovely afternoon.
Thank you, everyone. Cheers.
Thank you. Bye-bye.